Double taxation is a tax principle referring to income taxes paid twice on the same source of income. What is DTAA? Double Taxation Avoidance Agreement. A warm welcome to one and all. This is your ALsir here, lecturing Vidhyaashram First Grade College, the Temple of Excellence. And now we are discussing your session 5 of corporate tax planning. Under this, we are discussing topic called tax payment. And under tax payment, as you know, the two topics we already covered, which are one is tedious and one more we call it as your advance tax. We're done with all your practical things under this particular unit, and the only thing is left out is the theory part. What is the theory part? TCS as well as double taxation. So you will not get any problems on TCS and double taxation, but you may get 5-mark theory from this particular topic. Don't go in depth about TCS and double taxation. Just try to remember a few points which are related for your examination. I'll mention which are the things you are supposed to remember. That much only sufficient for your exam. So agenda is very simple. We'll go with the concept along with meaning. Double taxation. So what do you mean by double taxation? I'll read out the meaning. I'll give you an example for that. Double taxation is a tax principle referring to income taxes paid twice on the same source of income. Then it can occur when income is taxed at both the corporate level and personal level. Double taxation also occurs in international trade or investment when the same income is taxed in two different countries. Very simple example I'll give you. Just assume that you are working in abroad, like Dubai. We can take an example of Dubai. In this, what happens? You are working in Dubai. Yes. Now, so you got salary of 1 lakh per month. Now, you are the Indian resident. Normally what happens, even though you are Indian resident, if you earn your income in the abroad means, normally it is taxable there, or sometimes it will be taxable here. According to it depends on your number of days you stayed in abroad or in India. Your residential status has to be calculated. According to that, your tax will be calculated. In this example, just assume that your every month's salary is 1 lakh. And you are paying tax in Dubai. You are paying tax where? Dubai. Again, on the same income, being a resident of India, you are paying tax in India also. In Dubai also, you are paying tax on 1 lakh. In India also, you are paying tax for that good. This is called as double taxation. See, two different countries are charging tax on same income is called as double taxation. Or else you bought something from abroad and you paid tax there also, and you are paying tax in India also. That is also called as double taxation. Now see, double taxation is a tax principle referring to income taxes paid twice on the same source. Source means what? Your income. So whatever income you earn, on that again 2 times you are paying tax. That is called as double tax. Now, it can occur when income is taxed at both the corporate level and personal level. Corporate level, like income, whatever income you earned in the company also it is taxed, and after you are receiving your individual income tax also you are paying on that. Again, it is what? Double taxation. Double taxation also occurs in international trade. So this is what I explained you. Dubai and India, whatever salary you got, you are paying tax there also, you are paying tax in India also. These are called as double taxation. Hope you got it? Yes. How double taxation works? How it works, will go one by one. Double taxation often occurs because corporations are considered separate legal entity from their shareholders. Like company is different, you are different. Company and you cannot become one and the same. That is the reason double taxation occurs. Like your income, some 1 lakh is there in the company has to pay tax to the government. Yes. And Once you receive that 1 lakh rupees, you are also supposed to pay tax to the government. Yes, these are called as double taxation. The first reason is company is a separate legal entity. That is the reason you are paying double taxation. Second, corporation pay taxes on their annual earnings just like individual. Whatever we are paying tax every year, similarly, the company also pay tax every year. Yes, then it will be what? Double tax. Then, when corporation pay out dividend to shareholders, those dividend payment incur income tax liability for the shareholder who receives them, even though the earning that provides the cash or pay dividend were already taxed at the corporate level. I'll give you simple example. Just assume that XYZ is a company. XYZ is a company. Now, they got profit of 50 lakh. What is the profit here? 50 lakh. XYZ is a company. Their profit is 50 lakh. Should they pay tax? Yes. So normally companies, how much they pay tax? 30%. Now, 50 lakh into 30%, they will pay around 15 lakh as tax. Hope you are clear? Clear? Yes. In this, what happens? Whatever 50 lakh profit is there, it will go to whom? Shareholder. So, shareholder 1 will get 10 lakh, another person will get 10 lakh, 10 lakh, 10 lakh and 10 lakh. All the 5 persons will share the profit. That is called as dividend. So here what happens? Just assume that 55 lakh. So it is 11 lakh, 11, 11, 11, 11 lakh. Now, everybody got how much dividend? 11 lakh rupees. Now, company already paid tax on 50 lakh. Yes, they already paid because for company that is a profit. Hope you are clear up to this. One time company paid tax on this 55 lakh. Now, so assume that 15 lakh 50,000 after adding this 5 lakh. Now, 11 lakh is distributed among the shareholders as dividend. What is the rule says? Any dividend exceeds 10 lakh, even though dividend from Indian company, all the dividend from Indian company is not exempted. If the dividend amount exceeds 10 lakh, the individual has to pay tax. Yes, on 11 lakh, he will pay around 20%. Assume that he will pay 2,20,000 as a tax. 2,20,000 tax. 2,20,000, 2,20,000. This fellow also will pay tax. Company also paid tax on 55 lakh. All these 5 members also paying tax on their individual dividend. Here what happened? What happened is, here also they pay tax to the government. On the same amount, these people also pay tax. What is this? This is called double taxation. Hope you are clear. Yes. Whatever statement is there for this, there is an example. Then, next, type of relief. You don't want to pay double taxation. You want to avoid double taxation. Why should you pay 2 times tax on same income? Will you do that? Like, you are going for movie, like some XYZ movie. You have taken ticket for 200 rupees. Will you pay again 200 to go to that movie? No, because already you paid. Why should you pay again? You have taken ticket, you went to theater. Will you pay again for that 200 rupees for that movie? No. If you want to go second time, then you are supposed to pay. But already you have taken ticket means don't pay again. Show the ticket and get inside. Hope you clear? Yes, this is called your double taxation. How to avoid this? These are the reasons, plans are there, you can avoid. Like, relief from double taxation can be provided in 2 ways. In 2 alternative 2 options are there. First, bilateral. Bi means always remember both. Bi means always remember, bi means what? Both. In this, bilateral relief, when there is an agreement between 2 countries, relief is calculated as per mutual agreement. Between such 2 countries, bilateral relief can be granted by either of the following method. Now, so bilateral means what? Just you take an example of the old example what I gave. India, Dubai. You're Indian. Just you can take example of mine only. I went to Dubai and whatever salary I got there. So, I have to pay tax there also, I have to pay tax here also. That was double taxation. I want to avoid that double taxation. How can I avoid? The reason is very simple. Exemption, like bilateral. When there is an agreement between two countries, relief calculated as per the mutual agreement. The Dubai and India, they do mutual agreement. Not only for me, like me, there are lakhs together people are working. So the two countries will sit together and they will discuss. What they will discuss? First one. The first one is exemption method. Under this method, income is taxed in only one country. Like they will come to a mutual agreement, like India says that that person is in Dubai, you only collect tax. And Dubai says that that person belongs to India, you only collect tax. Like that, they will come to mutual understanding. One country will be exempt from tax, one country will be you're supposed to pay tax. Hope you got it. Good. In this situation, what happened? I am in Dubai, even though I am Indian, Indian says that you only collect tax. India will say to Dubai that you only collect tax from that person because right now that person is in Dubai. Then what happens? I'll pay tax in the Dubai. When I come to India, Indian will not ask me tax. Hope you are clear, because the mutual agreement is done. This is first. Second, tax relief method. Like under this method, income is taxed in both the countries. Relief is granted in the country of residence. So what is the tax relief? May assume that 1 lakh is my income. I am in Dubai. What is the tax rate in Dubai? So if you go to the practical, there is no tax in Dubai for your salary. Okay. Only we have VAT. There is no income tax in Dubai. Assume that in Dubai you have 40% tax. How much you have? 40%. Now, others will take it as 20% you have tax in Dubai. What is the percentage in Dubai? 20%. And example I am giving. Now, you already paid 20% tax on 1 lakh. 20% is how much? On 1 lakh, 20% means 20,000 you paid tax. Now, you came back to India. Already you paid tax. You will show that challan to Indian government. See, I have paid 20,000 tax. What Indian will say? Okay, as per India, you are supposed to pay 30%. As per India, how much you are supposed to pay tax? 30%. But how much you paid in Dubai? 20%. Then Indians will say, okay, you don't pay again 30% here. Whatever 20% you pay to Dubai, will adjust that. You pay me only 10%. On 1 lakh, 10% means you are supposed to pay 10. Why? Because balance 20% already you paid in Dubai. Hope you are clear. Yes, these are the two options you have. One is one country completely give up, don't pay. One more option is whatever you paid there, come here. Whatever extra is there, you pay only extra. Don't pay full. Only the addition you pay. Assume that Dubai also 20%, India also 20%. Then what happens? Indian will not ask even 1 rupee also because you already paid there. Hope you are clear. Yes. Now, so this is the second. This is the first method of your tax relief. The second one is unilateral. Unilateral means you only single individual. When there is no mutual agreement between the country, relief is provided by home country. Normally what happens, Indians goes to UAE or Dubai, they will ask that, will you do this thing? Will we do mutual understanding? The UAE people or Dubai, they will say that, no, I am not ready for any mutual agreement. Then what happened? Indians, they will only decide themselves that we will not collect tax from that person. That is called unilateral. Single country will decide. Bilateral, both the countries will decide. Hope you are clear. B for both the countries. Unilateral means you only. Single country will decide. So relief under continuation. Section 90 of the Income Tax Act. It is associated with relief measure. Taxpayer involved in paying taxes twice. That is, taxes in India as well as foreign countries are territory outside India. And next, this section also contains provision that will certainly enable the central government to enter into the agreement. Sometimes central government will interfere for all this agreement. Further, intend to grant relief for the taxes paid in India and in any other country outside. Let us understand with an example. So example is very simple. Whatever I explained you, keep it in your mind. We'll explain you the example. Now, Mr. Ankit, a resident, earned income in India 4 lakh. What is his income? 4 lakh. He also earned income from a foreign country, that is 1 lakh. One is 4 lakh, another one is 1 lakh. Tax paid in foreign country, how much tax relief can he claim and how much tax he has to pay? Again, I'll repeat. He earned income in India 4 lakh. He also earned income in foreign 1 lakh. In India 4 lakh. In foreign 1 lakh. Tax paid in the foreign country. Already paid 10,000 tax in foreign. How much tax relief he can get? So it is India and this is foreign. What is his income? In India it is 4 lakh. In foreign it is 1 lakh. How much tax he already paid? In India nothing he paid. In foreign 10,000 he already paid. Okay, these are the informations we have. Now, the tax relief. The relief shall be calculated as follows. Global income 5 lakh. How it is 5 lakh? 4 plus 1, it is 5 lakh. That we call it as global, all the both countries. Tax on global income 12,500. If you take 5 lakh, you can calculate your tax. How to calculate? Simple. Up to 2,50,000 nil. Balance 2,50,000. So if you calculate 5%, you will get 12,500. So all put together 5 lakh. Remember, hope you are clear. All put together how much it is? 5 lakh. Now, on 5 lakh, if you calculate tax, you will get around 12,500. Hope you are clear. Good. Now, average tax rate, like after calculating everything, it is 12,500. Already how much you paid in abroad? Already you paid 10,000 and remaining 2,500 you are supposed to pay. Because already in abroad you paid 10,000. In India they are asking only how much? You pay 2,500, nothing to pay. Hope you are clear. Yes, this is all about your double taxation relief. You will not get any problems on this, nothing to worry. Only theory you are supposed to remember. Now, so these are the reliefs. We have double taxation avoidance, double taxation avoidance agreement. Remember, what is DTAA? Double taxation avoidance agreement. DTAA, double taxation avoidance agreement. So your agreement comes under section what? 90A as well as 90. It all says about your double taxation avoidance agreement. Hope you are clear. Yes, this much more than sufficient for your 5 marks in your examination. So this is also your relief, and the next part, steps to compute relief. Like double taxation avoidance, you understood. How to claim that how to claim that relief? Very simple. Calculate the tax payable in India. In India, how much? Just now we did the example. Remember that example. Calculate how much tax payable. Like as per your example, when you calculated on 5 lakh, 12,500 was payable. Compare Indian tax rate and foreign tax rate. Both you compare. Multiple the lower tax rate with the doubly tax income. Out of these two, which is lower, you compare. Relief will be the amount as computed in step 3. So whatever the excess are there, that will be taxable and rest will be exempted relief. So with the help of example is there. Tax payable in India is 1 lakh into 30%, it is 30,000. Lower tax between 30% and 20% is 20%. And 1 lakh into 20% is 20,000. Like as I told you, in Dubai it is 20%, India it is 30%. 20% is exempted, balance 10% you are supposed to pay tax. These are double taxation. As I told you, don't go in depth. Only 5 marks, how much is required? That much only you remember, then it is enough. So next topic will be TCS, tax collected at source. Who will collect the tax? The seller will collect the tax. Like you go and buy one mobile. So just assume that 10,000 mobile and 1,400 will be the tax. How much that shopkeeper will take? 11,400 he will take. The extra 1,400 is there, no? That is nothing but your GST. Hope you are clear? Yes. The GST amount we are not supposed to pay directly to the government. The shopkeeper will collect and he will pay to the government. Now, so whatever the tax collected by seller from the buyer is called as TCS. Again, I'll repeat, whatever tax collected by seller from the buyer is called as TCS. Now, TCS is additional amount collected as a tax by a seller, specified goods from the buyer. Not on all goods. There are specified goods are there. For that only we call it as TCS. Or else normal tax, GST only. Time of sale over and above the sale amount and is remitted to the government. What seller will do? He will collect from the buyer. Like assume that I am buyer, you're seller. I am the buyer, you're the seller. I purchased mobile from you. What should I do? I have to pay 10,000 and 1,400 tax, 11,400 I should pay. What will you do with 11,400? 10,000 you will keep it with you, but 1,400 you will go to government and you will pay the tax. That is called TCS. TCS only on certain goods are there. I'll tell you which are those goods. Now, as per Income Tax 1961, certain persons being the seller must collect a specified percentage of tax as given in para 8 below. This is as per the income tax. The same thing is taken here. So don't go in detail. TCS means, remember, whatever tax collected from seller from the buyer is called as TCS. What is his duty? He has to deposit the tax amount to the government on specified goods. Classification of seller and buyer for TCS. These are the classification we have. Under TCS mechanism, seller is defined as any of the following, like central government, state government, local authority, statutory company registered under Companies Act, and cooperative society, and any person HUF who is subject to the audit and of accounts. These are the types we have for companies. And a buyer is classified. Not only the seller is classified, even buyer also classified. How? Public sector, central government, state government, embassy, consultant, club, and local authority. These are the classification for buyer. Almost it is similar only. What are the classification for seller? 5 to 6 points. What are the classification for buyer? 5 to 6 points. And these are the TCS rates. No need to remember. Not required. Just read it once. Liquor, alcoholic and all, you will get 1%. Timber are 2.5%. Tender leaves are there, that comes under 5%. And from May, these are the rates. So these are the items are there, like timber obtained 2.5, forest produce 2.5, scrap 1%, minerals 1%, purchase of motor vehicle exceeding 10 lakh 1%. Parking lot and toll plaza, it is 2%. These are the rates we had actually. But from May 2021, what is the rate? These are the rates. Hope you are clear. Because of the COVID pandemic, the rates are reduced only for 1 year. Later, again, the same old rate will come. In exam, they will not ask you any rates. Only you are supposed to remember what is TCS and what are how buyers are classified, how sellers are classified. Now I'll go back to all the previous slides. Please take screenshot. So your agenda, your double taxation, how double taxation works, types of relief, relief under section 90, examples, relief under section 90A, relief under section 91, steps to compute relief, tax collection at source, Classification of sellers and buyers for TCS. TCS is not necessary for the following buyers. Yes, goods and transaction covered under TCS. See, these are the things which are not for buyers. And these are the percentage. And these are the percentage. Revised as well as old one. These are the percentage for only 1 year. So this is all about your today's session. Hope you're done with the concept. So you understood the concept. Please work out just 5 and 5 marks theory you may expect from this topic. Thank you.